When evaluating an investment opportunity, whether it's stocks, bonds, real estate, startups, I found that I like to use the same type of considerations or criteria every time. And these are 5 simple things that I check the box of before you even get into more technical analyses or anything like that. And the point of these is just to see how the investment fits into my goals at the time. In today's video, I'm going to share with you the considerations that I think about and a little bit of context as to why I think they're important. You can see the timestamps in the description, but with that in mind, let's get into our first thing, which is time horizon and liquidity. This can vary greatly based on investment type. For example, if you're investing in a stock and you just want to hold it for a couple months, you'll be able to access that cash or sell that stock relatively quickly. On the other hand, if you're considering investing in a startup or venture capital fund, you may have to invest this money today in order to earn that return 5 or even 10 years down the road. If accessing the cash is going to be something that you want to do on a monthly basis, then it could take investments off the table immediately. One other thing to keep in mind with time horizon and liquidity when you're thinking about this is that you should get paid back for tying up your money for a long period of time. What I mean is when you're investing in the stock market, you should get on average 7% per year. And again, you can access that money immediately if you were to ever need it. You could sell your position. When you are considering these investments that take a long time to come to fruition, not only should you be getting the 7% per year, but you should also be getting a little bit of a premium for locking up your money for that long. So not only is time horizon important for whether you need the money now or will need the money, it's also important because it helps factor into what type of returns you should expect and if you think that this investment could hit those returns relative to other stuff that you can be doing. The next thing I think about is risk tolerance. And this is individual. It has a lot to do with stage of life or how much money's in the bank or whatnot. But generally, the higher the risk of the investment, the higher potential reward. You could get paid back for that extra risk. That doesn't mean that riskier is always better. So for me, I like to make sure that I fully appreciate the risk going in. So when you're investing in a startup, it could very likely go to zero. And if you're okay losing that amount of money and you want that type of exposure or potential return, then yeah, maybe it's a good fit. But for me, even recently in this economy with the uncertainty, I haven't been taking on extra risky stuff because I already have a lot of risky investments in my portfolio. So that's just something that I keep in mind is how much risk do I want to take on at this current moment in time. The next thing I like to keep in mind is market conditions. If you're investing long-term, then market conditions won't matter as much. And what I mean by that is if you're investing for your retirement portfolio, the market conditions of today won't affect 20, 30, 40 years down the line. Everything should start to even out over time. However, if you are investing in the short term or you're looking for some sort of return over the next 3 months or 12 months, market conditions will play a critical role in the outcome. Meaning, if market conditions are bad and you're buying a stock, but there's a ton of headwind in the market, even if you buy a good stock, the market conditions could hold it down. So if I am making a shorter term investment or even something that's a couple years down the line, I make sure to keep in mind the market conditions because when I make this investment, especially if I think that things are going to go up, that means that to some extent, I am betting that the market will also go up. And it's important in times like today to have a hypothesis as to what you think is going to happen if you are planning on investing in the relatively shorter time frame. Next, no matter what, I think about how this fits into my overall portfolio of investments. And this doesn't just mean stock investment portfolio. Here's an example. If you work in a startup and you invest in startups, you are highly, highly concentrated in startups. That means if the market were to take a major downturn, as it has over the last couple of years, everything is at risk. Your investments, your job, your equity at your job, that is all affected. So what I keep in the back of my mind, and I don't do the best job of this, is I try not to be overly concentrated in one market or industry. If you work in real estate, instead of just investing wholly into real estate, maybe it's worth shaking things up a little bit and putting some money into bonds or treasuries or startups or tech stocks, because then you're diversifying your exposure. And there are many, many books and videos and talks about the importance of diversification, whether it's in stocks or in general assets. But for this case, I'm just gonna say, like, for me, I like to make sure that this fits in safely into what I'm doing overall, so I'm never left in a situation where there's a bad beat and then all of a sudden everything that I have is affected negatively by it. Let's say you've checked the box on all of these different things and it's a good risk for you, it's the right time, you believe in the market, and it fits well in your portfolio. The last thing I like to think about, and it's probably the most fun or important thing, is just a gut check of why I'm making this investment. For me, I need to have 110% conviction in what I'm about to invest in. If I have 1 foot in, 1 foot out, then it means that I may not be that excited about the opportunity and I should just pass right away. Some of my best investments come from gut feelings. My mom is actually a great stock picker because she's a relatively early adopter to different things. And if she finds something that she absolutely loves, she'll just buy the stock. So this consideration is, do I have a strong position here? Or am I just doing this to do it? If I'm just doing it to do it, it's probably a pass, but if I have strong conviction about what's gonna happen, then sure, maybe it's worth the investment. Those are my 5 considerations. Thank you for watching. If you have other considerations, I would love to see them in the comments. I'll respond to every one of them. If you wanna see more business stuff, please consider subscribing. Hope you found this helpful. See you in the next one.